name is Jennifer Vale. I'm an Associate Director with Civitas Strategies. We are very pleased to be here tonight. That Growing Up New Mexico and Crusair have been kind enough to have us here tonight speaking with everyone. So we really thank you very, very much. Tonight, we're going to speak about the Employee Retention Tax Credit, which is also known as ERTC. A lot of people know it by that name. And we're going to talk about the Families First Coronavirus Response Act, which is known as FFCRA. So we expect today's presentation to run about 50 minutes or so, and then we're going to have time for questions at the end. What we're going to do is the way that these Zoom breakout rooms work is that we will ask you to please hold your questions. Once we're done with the English presentation, we're going to go back to the main room. So you're going to be able to basically say that you're leaving the room and you want to stop and you want to join the main room again. Over in the main room, that's where we're going to answer questions. So we're going to have you either in the main room, put them in the chat, or we'll allow folks, if time allows, to just ask their questions as they have them. However, anything that's put in the chat here, we cannot see it when we get back to the main room. So I'm just going to ask that everybody hold off on your questions. We'll get back to the main room. You'll exit this. We'll meet up in the main room with our folks from our Spanish room, and then we'll get to asking questions. So we'll do that. All right. So just before we start, just want to give you a quick rundown, a little mention of our disclaimer. So the information that's contained here has been prepared by Civitas Strategies on behalf of New Mexico Early Childhood Education and Care Department, West and Growing Up New Mexico, and it is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited, and only non-commercial uses of this work are permitted. So let's go here. All right, so today we're going to discuss what is FFCRA and what is ERTC. What are they exactly? We're going to go over the benefits of each. We're going to talk about how you determine the eligibility, and we'll show you how you claim the credits. So starting with FFCRA, if you had any staff or yourself who needed time off in 2021, so during the height of the pandemic, for any of the following: if they needed time off and they were paid but were not working at the business because they had corona, if they were quarantined due to COVID-19 exposure, if they were taking care of immediate family members who had COVID, or if they had to stay home because their child's school was closed, or they needed to remote school their children. That's what this credit was created to do, basically. So if you answer yes to any of those questions, again, either for yourself or your employees, you may be able to qualify for FFCRA credits. Now, for ERTC, if your business meets the eligibility requirements, which we will go over, again, in 2021, you may qualify for what are payroll credits. Now, we're going to review the eligibility of ERTC in a later section of the presentation. So we will talk about whether, how you'll determine if you're eligible. The credits can be quite substantial depending on the amount of employees that you had in 2021, but there are very strict rules surrounding eligibility. All right, so you want to closely adhere to those rules when you calculate your credits. That goes for FFCRA as well, but I will explain a little later about ERTC, why it's very, very important that everything be buttoned up. So we'll start with FFCRA. And let's take a look. The first thing we're going to do, though, before we talk about that, is I just would like to mention that FFCRA and ERTC credits are issued by the IRS, and they involve very specific time periods in 2020 and 2021. Now, since these are both tax credits, there are IRS tax filing deadlines, all right? So what has happened is for 2020 ERTC and FFCRA, the filing deadline was April 15th, 2024. So we just missed the opportunity to file for 2020 ERTC and FFCRA. But for 2021 credits, the filing deadline is April 18th, 2025. So we still have almost a full year to file for any credits that you would be eligible for that time period in 2021. So yes, you can no longer file for the 2020 credits, but you can still file for 2021s, and there's no reason not to. You'll see throughout the presentation that I have edited to address that the credits are just specific to 2021. So the reason I bring up 2020 is you may have heard that the credits were also available in 2020. I just wanted to explain to you why we're only focusing on 2021 this evening. So just so that you know why it's not there. All right, so let's discuss FFCRA. Now, when the pandemic struck, we know that many small businesses had difficulty providing additional sick leave that was needed due to COVID-19 illnesses or quarantine. At times, employees may have needed to stay home, right, to care for family members, and we do know the situation existed with children needing to be homeschooled or their schools were closed. As employers, that then put a burden on you in the fact that you were paying individuals, because that was the rule at the time, you were paying individuals who perhaps were not actually working in the business at the time due to one of those reasons. So basically, the FFCRA exists because you had to put that money forward to pay these employees. But that's difficult, right? At that time, it was definitely a burden. So now the federal government created the Families First Coronavirus Response Act leave. So it provides funds in the form of tax credits that address your payroll during that time period. And the whole idea of these credits is to help alleviate the economic impact that came from needing to provide that leave, right? So this is definitely something that the government has created because they know that during that most difficult time of the pandemic, there were many situations where employees were paid but weren't actually able to work in the business there. Now, as I mentioned, right, we know that it originally, FFCRA originally was available from March 15th, 2020, all the way through September 30th, 2021. But everything we're going to talk about today is going to be about from January 1st, 2021 through September 30th, 2021, since we can no longer file for the credits for 2020. So we're going to talk about credits that would be earned in quarters 1, 2, and 3 of 2021. Now, if you have less than 500 employees, you can take advantage of FFCRA. So if anybody's here on the call has more than 500 employees, unfortunately, FFCRA you would not be eligible for that there. And you are eligible for FFCRA even if you are a sole proprietor without any W-2 employees, if you're considered to be self-employed on a 1099. Even if it's just you can still take advantage of the credit. You do not have to have paid yourself via W-2 during that time to claim the credit for yourself. So that's very nice there. Just a little bit of information is that if you received a PPP loan, you cannot double count that money. So what does that mean? It means when we start to look at how you calculate FFCRA, you're never going to be able to use the same time period of payroll that you received a PPP loan. So if I received my PPP loan, let's say in February of 2021 through the end of March 2021, I won't be able to claim any credits for any absences during that time period because I've already received money for the PPP loan. So that's important to note. If you happen to have filed for ERTC in the past, the same rule applies so that you cannot file for FFCRA during any time period that you've already received ERTC credits. So we just want to remember that situation there. And again, if you have more than 500 employees, this is not going to be a credit that you will apply for. All right. So what actually is the benefit of FFCRA? What are those benefits? Well, there were two different types of leave credits that were available. This is a little bit of a mouthful, but the Emergency Paid Sick Leave Act, which is also known as EPSLA, provides up to 80 hours of sick leave for employees from January 1st, 2021 through March 31st, 2021, and then an additional amount of 80 hours from April 1st, 2021 through September 30th, 2021. So keeping in mind that we have the ability, if employees were eligible or you yourself were eligible, you would be able to claim up to 160 hours of pay with these credits if, again, from January 1st through the end of March 2021, and then that number for 80 hours resets again April 1st, 2021 through September 30th, 2021. Now, there are limitations. So if an employee were to have COVID or to have had to stay home because of COVID exposure, they actually, the amount of money, the cap to which you can receive credit is basically their regular rate of pay per hour up to $511 a day with a cap of $5,110 for the whole 80 hours. So that is if they had COVID or they had to quarantine due to having COVID. So if somebody was out with COVID, up to 80 hours of their regular rate of pay, as long as it does not exceed $511 a day. So there's that. Now, if an employee had to stay home to care for a family member with COVID, or they had to stay home to care for a child that was being homeschooled, in that instance, they are eligible, or you are eligible for a credit of 2/3 of their regular rate of pay, which means that you can claim for any individuals under those two circumstances up to $200 per day with a cap of $2,000 for each 80-hour time period there. Now, school closure, home remote schooling, all of those are considered to be the same thing under this rule, and would receive you'd receive credit of the 2/3 rate of pay. Now, there is also something that you may have heard of that's called the Emergency Family and Medical Leave Expansion Act, which was the EFMLEA. So what that was for is that if you had employees who had to stay home to care for their children, they actually by law were allowed 12 weeks of expanded family and medical leave, and 10 of those weeks were able to be paid at 2/3 of the employee's salary, but the same cap remained, so that you basically, the same exact financial amount of credit in the fact that you could claim up to $200 per day with a cap of $2,000 for your employees. That existed to make sure that anyone who had to care for children who were at home were able to do so without their jobs being put in jeopardy. You would not be combining those two types of credits, right? So we would not be combining a credit for the EFMLEA. We would not be combining that credit with the EPSLA. So you just want to basically keep that in mind. So it's not like you can say 80 hours I'm going to claim for the EPSLA, and then I'm going to claim another 80 hours. Basically, when we look at the year of 2021, you would be picking into, it would be one or the other. You would not be not mixing and matching those two programs. All right, so we know what those daily limits are, but how do you actually claim the credit? Claim the benefit, I should say. So basically, you get reimbursed through a refundable tax credit. So a technical way of saying that the US Treasury pays you for money from employment taxes that you originally paid, and you get those credits back in the way of checks. So basically what it comes down to is it's a reimbursement for the wages that you filed on your original 941 form for that corresponding quarter if you had W-2 employees. We'll talk about sole proprietorship, what that looks like there. So basically, how do we go about claiming the benefit? Well, what you're going to do is that this will start with W-2 wages, and then we'll work our way into sole proprietorship. So the first thing that you would do is you would pull your payroll reports to determine when your employees, and if you pay yourself on W-2, this would be the same case. You're going to pull those payroll reports and you're going to determine when your employees or yourself were out due to those qualifying circumstances, right? So when was an employee, let's say we had an employee, Jane, when was Jane out? What time period was Jane out? And what reason was Jane out? Did she have COVID or quarantine due to COVID? Or was she home because she was caring for a family member or her child needed to be homeschooled? So we pull those reports because we're going to track the reasons why the employee was out. We're going to track the amount of time the employee was out. And the reason for that is that FFCRA is addressed in quarters in 2021. So quarter 1, 2021, quarter 2, 2021, and quarter 3, 2021 are each looked at individually. So when you file for these credits, if you have employees, maybe some of your employees qualified under quarter 1, and then maybe you had some employees that their timeout was in quarter 3, you'd be filing separate forms with the IRS for those employees. So you pull these payroll reports, and I'm going to show you a very simple spreadsheet. Basically, what you would end up doing is laying everything out in a spreadsheet to see what the credit looks like. Now, these credits are self-certifying. So the spreadsheet, the very simple spreadsheet I'm going to show you next, you don't actually send that into the IRS. What you do is you make that for your own records, you use that to calculate the credit, and then you would hold on to that in case the IRS were ever to come back and ask what proof you had. You would have your payroll reports and you would have the spreadsheet to show how you came up with the calculation. So let's look first at this W-2 wages, and then I promise we're going to talk about sole proprietorship. All right, so this is a really, really simple spreadsheet. This is an example of what you could put together, again, so that you are able to perform the calculation, and so you are able to have proof for the IRS if they were ever to come back. So this is for anyone paid via W-2. So what you do is you track the employee name, the dates that they were absent per quarter. Now, you don't see this here, but if this was an Excel spreadsheet, I would have a tab for quarter 1, a tab for quarter 2, and a tab for quarter 3. And I would have those 3 separate spreadsheets because I know I'm going to file for the credits individually per quarter. So I've got the name, the dates of the absence, why were they absent? And that's because you're either going to get the full rate of pay or you're going to get 2/3 rate of pay, right? So we need to know that. We need to know the number of hours that they were absent. So we have the dates, but what if an employee was part-time, right? And perhaps they were out for 10 days, but they only worked 4 hours a day. They wouldn't be the total of 80 hours during that time period. So we need to know the amount of hours that they were absent over that time period. We need to know their hourly rate of pay, and then we calculate the credit. So if we look at this example here, Jane was out from February 18th through February 19th, 2021. She had COVID. That amounted to 80 hours that she was out that you paid her for. She makes $15 an hour. Well, $15 times 80 is a credit for this employee of $1,200. So super straight, easy, simple. You'll see Juan is our next example, where Juan was out from the 18th of January through the 29th because his child's school was closed, right? So it was either closed, he had to homeschool. That was still 80 hours that Juan was out. And he makes the same rate of pay as Jane, but the credit is only $800. And why is that? Well, that's because only 2/3 rate of pay is what we are eligible for credit for Juan, because he was home due to the child's school being closed, right? So that would not be that same 100% rate of pay that we were able to receive for Jane. So those are the circumstances. So you make a spreadsheet like this for each quarter. You track any employee absences or yourself if you paid yourself via W-2. So these spreadsheets are for our W-2 employees or ourselves. So this is that simple spreadsheet. Let's look at what we do for sole proprietors. All right. So if you're a sole proprietor, things are going to be a little different, because you're going to base your credit, you're going to calculate it actually based on line 31 of your 2021 Schedule C, not what you pay yourself. So the number that's on the line 31 of your Schedule C is what the IRS actually considers to be the amount of your self-pay. So if you were paying yourself a certain dollar amount, unfortunately, you're not going to use that amount to calculate the credit. You're going to use whatever number is on line 31 of your Schedule C for 2021. Calculation is not difficult at all. So basically, you go back and you determine the number of hours you were out and those days, right? Because we need to know, are we filing in quarter 1, 2, or 3? Or because you can have credits from 80 hours from January 1st through March 31st, 2020. You could have a credit in quarter 1. But if you were sick again, if you were out, if you had to close the business because you couldn't work, or if you had other people working and you just couldn't work, you would still have the opportunity for another 80 hours from April 1st, 2021 through September 30th, 2021. So basically what you're going to do is you're going to take line 31 of the Schedule C, and you're going to divide that number by the number of business days in a year. In 2020, that was 249 business days. So what that does is that gives the amount that the IRS considers to be your rate of pay for an 8-hour day. Everything is based around 8 hours. So even though we know that our child care professionals are working often far longer than 8 hours, they're looking at 8-hour days, right? A maximum of 10 8-hour days for a total of 80 hours for each of those 2 time periods. So if you were out due to having COVID or having to quarantine, basically we've now taken the number on line 31 of our Schedule C, we've divided it by 249 days in the business days in the year. That's how much the IRS considers us to have paid ourselves per day. So if we're out due to having COVID or having to quarantine, we're basically going to take the number of days we were out and multiply it by that number that we've determined is our daily rate of pay. And then keep in mind, if we were out because we had to care for a family member with COVID, or our child was being homeschooled and it has to be your child, then you would be receiving 2/3 that rate of the day's rate, the rate of the day's pay. So basically, you have to remember that you're not going to exceed more than 10 days between January 1st, 2021 through March 31st, 2021, and then another 10 days, right, between April 1st, 2021 and September 30th, 2021. So let's just look at this example here. So we're saying that the starting point is line 31 of the 2020 Schedule C. IRS considers that to be the amount of your self-pay. In this instance, in our example, line 31 was $56,000. We're then going to divide that number by 249, the number of business days in a year. That gave me a total of $224.90 a day. We're going to say in this circumstance that this particular business owner, sole proprietor, was out due to having COVID. So she's going to be receiving a full credit for the full amount. We're not looking at the 2/3 there. So we take that $224.90 for a day's pay. We multiply it by 10 days. When we looked at how long the sole proprietor was out for, that child care provider was out for the equivalent of 10 8-hour days. I multiplied $224.90 by 10 days, total credit of $2,249. So what happens with that? How do we handle that? Well, In this instance, what would happen is that you are going to end up filing a 1040X, which is an amendment of your original 1040 form. And then there's also a form that's called the 7202. And 7202, I should say. That is a form where you basically are listing the time that you were out. So these credits are filed with the IRS. You fill out the 1040X. You go ahead and you mail that in if you're a sole proprietor. If you are, if you had W-2 wages and you were paying employees through W-2, like the example we saw before, that credit is claimed on what's called a 941X form. And that's an amendment of your original 941. So basically, those are the ways that you receive the credits. You fill out the forms, they get mailed in, a little archaic, but they do get mailed in. Actually, the 941X gets mailed in. You can do a 1040X actually through tax software if you wanted to. Or a tax preparer could help you with that as well. You fill out those forms, they go to the IRS calculates the credit, they make sure that the information, basically you're self-certifying, so you're not sending them that spreadsheet, but they're looking to say, hey, does this align either with, for sole proprietor, their Schedule C for 2021, for those people being paid on W-2 wages, does it align with the original 941 that was filed? And then they issue checks. The unfortunate thing with both FFCRA and ERTC is that the checks now are taking at least 6 months to be issued. So there is a certain amount of patience, excuse me, that needs to be had in terms of receiving these credits. So FFCRA is straightforward. It is really fantastic in the fact that sole proprietors, or if you're 1099, you can receive the credit. We're going to look at ERTC next, and ERTC is actually only surrounding employees paid via W-2. So ERTC does not apply to sole proprietors unless a sole proprietor had an employee who is not a family member. We'll talk about that. Has an employee that was paid via W-2 wages. So you could be a sole proprietor with W-2 employees, which is an excellent way to have your employees, all of your payroll set up. So you could have that situation, but it's only W-2 employees that you're going to be receiving an ERTC credit on. So some of the key points about ERTC is that it's easier than PPP, not a loan. It's payroll based. It has no constraints to how you can spend the money. So that check will come to the business owner. However you choose to spend that money is up to you. There's no forgiveness needed like with PPP. It's not a loan. So just like with FFCRA, it did originally cover from the middle of March 2020, actually it was March 13th, 2020, through September 30th, 2021, but we can only file for 2021, right? So most providers, most businesses are going to be looking at their, they're going to look at their eligibility and then look at their payroll from January 1st, 2021 through September 30th, 2021. However, if you had a business that opened at, on or after February 15th, 2020, they consider that business to be what's called a recovery startup. And what a recovery startup is the government basically saying you opened a new business during the most difficult times of the pandemic, you are going to be eligible for credits. Just by opening that business, you actually would be eligible for payroll credits in Q3 and Q4 of 2021. It's the only time any type of credit would ever be issued for Q4 payroll, right? So ERTC for the majority of businesses is from January 1st through September 30th. But basically Q3 and Q4 are credits where the a recovery startup business would be eligible. Now, many small businesses, including nonprofits, can be eligible for this, but government agencies and public school districts are not eligible. So you just want to keep that in mind there. Just like with FFCRA, we can still file for this credit retroactively for 2021 through the tax filing deadline of April 18th, 2025. So once again, you have time. And this is also applied for by amending your 941, your original 941 form, using a 941X form. So this whole credit is addressed and revolves around payroll paid to W-2 employees. There is an exception to that, that even if you were paying yourself as an owner via W-2, or you were paying any family members via W-2, you cannot include your wages or the wages of your family members. So if everybody was working within the business, as far as ERTC is concerned, we're only going to be filing for credits for our W-2 employees, not for ourselves or family members. Now, I'd be a little remiss if I didn't mention this slide is not meant to scare anyone, but basically I want to just discuss some of the details surrounding ERTC, because there is a certain climate with ERTC with the IRS. So over the last few years, many of you have received phone calls from very aggressive businesses promising you that every business is qualified for ERTC credits. Of course you're qualified, and they throw out numbers, $21,000, $26,000. They throw out these large numbers. But unfortunately, those predatory businesses have been less than ethical when determining true ERTC eligibility. They've blatantly ignored rules, and then they charge business owners 15 to 25% of the credit they were going to receive, even though that business wasn't really eligible. So what we expected this, we saw these predatory companies, what they were doing. And just as we in our organization had expected, the IRS is coming down hard on addressing this issue. So what's really unfortunate is that many businesses who received credits and they've already spent the funds, they now have to pay back the entire amount of the credit, including the money that they gave those predatory companies, and they have to pay penalties and interest on top of what they already owe. So I'm bringing it to light not to discourage you from filing for 2021 credits, but just to encourage you to be really diligent when you determine your eligibility and when you calculate your credit. So how do you determine if you're eligible, right? We know we're going to stick with those rules. So basically with ERTC, there were 3 different ways that you could be eligible. So the first one is if you had a decrease in quarterly revenue when you compare quarters in 2021 with the same quarters in 2019. So we'll talk about how much you had to have a decline, but that's the first way that a business would be eligible. Basically, they would have to have had at least a 20% or greater reduction in revenue when you compare 2019 to 2021. So that is the first way that you could go about qualifying for ERTC. The next way, you need to be very, very careful of using this as the reason for eligibility, and especially now that we're only looking at credits in 2021. And that is if you had a closure or a reduction in your capacity or a reduction in the ability to provide services due to a government order, not a suggestion, but a government order, either state or local. So you have to make sure that you have written documentation of that. So if you feel really strongly that there was a government order in place sometime between January 1st, 2021 and September 30th, 2021, good. If you have the documentation, if you're able to prove that, fantastic. But because that can be so, for a lot of businesses, it was very difficult for them to determine if they really were eligible, and those predatory companies jumped all over that. All right, so those predatory companies bent the rules. They would say things to people like, well, your business, you had to buy PPE, which meant that you limited the number of children that could come into your business. It has to be a legitimate government order. Would have had to have reduced your capacity by at least 10%, reduced your ability to increase your revenue by at least 10%. One thing I just like to keep in mind now that I'm only talking about 2021 is that unlike earlier in the pandemic, when those government orders did exist, most of them had been lifted by 2021 or were lifted very, very early in 2021. So the more I speak to businesses about ERTC in 2021, I haven't come across a business that has had a legitimate government order still in place. There may have been a suggestion, there may have been a recommendation, but most governments had lifted the actual order prior to January 1st. So I would be very, very cautious if you're going to use that as your means of eligibility. The third way I had already mentioned, which is basically if you were a recovery startup business. So if you started a business anywhere from February 15th, 2020 through September 30th, 2021, that makes you eligible. There's no other type of eligibility requirements that you have to revisit there. And that means that you could receive payroll credits for Q3 and Q4 in 2021. So you don't have to meet any other eligibility requirements, but those are the three ways that you determine eligibility. Let's look at what I feel now is really other than a recovery startup, revenue reduction is the best way now to show eligibility for ERTC. So how do you determine if you have that revenue reduction eligibility? So what you're going to do is you're going to look at that gross revenue in 2019 per quarter. You're going to record what was the gross revenue in 2019. We're then going to collect our gross revenue in quarters 1, 2, and 3 in 2021. Now, keep in mind, gross revenue includes any revenue that you receive that you would be taxed on. So that also includes any funding that you received. So if in Q1 of 2021, you received a stabilization grant, you would have to include that money in your revenue for 2021 Q1. So we just like to make sure that everybody understands that they do have to go about making sure that they are claiming all of their revenue there. So what we do is we look at our gross revenue and then we calculate the decline. So let's look at this example. So that first line is about 2019, right? That's the baseline. So in 2019, in our example, we had $100,000 in revenue all 4 quarters. Well, you're going to see we don't address Q4 in 2021 because everything ended in September 30th, 2021. But so then I ran my gross revenue numbers in this example, and I had to have a 20% or more reduction in gross revenue when I compared 2021 with 2019. So in this Q1, this first example here, wow, I actually had an increase. I had $105,000 versus the $100,000 I had in 2019. I don't qualify. There will be no ERTC credits for that time period. But in Q2, I had a 22% reduction in revenue. It was only $78,000. Boom, I qualify, what I call triggering. I trigger ERTC. I am now eligible for that credit in Q2 of 2021 for the payroll, and we'll go over that, payroll in Q2 of 2021. There's an interesting thing with ERTC. If you look here at my example for Q3, I had an increase again, $110,000. So I had a 10% increase. But you'll see that I wrote down here that the quarter qualifies even with an increase. So there's actually a rule. I jokingly call it a bonus rule. That is not an official term. But basically, the quarter that follows the last quarter that you qualified for is also eligible. So in our example here, Q2, we qualified. Even though I didn't have that reduction in revenue for Q3, I still qualified because it was the quarter immediately following the last quarter that qualified. And in our example, we only have we're only looking at the 3 quarters, but I would be eligible now for credit using this example for Q2 payroll and Q3 payroll. So, and again, no credit in Q4 because unless I was a recovery startup, Q4 in 2021 does not apply. So how does it benefit you? So basically, what you would receive is a credit of 70% of up to $10,000 in wages per employee per quarter. All right. So basically, you have to make some required adjustments, but basically, when we look at that number, what does it mean? It means that in 2021, the maximum amount of credit that we could receive per quarter for an employee would be $7,000. So if I had an employee, the maximum being we can only count up to $10,000 in wages. So quarter one, I have $10,000 in wages for my employee Juan. Juan made $10,000. I get a credit for that first quarter of 70%, which is $7,000. And if Juan were to have the same amount of payroll, and if, let's say I was eligible for every quarter, I had met the eligibility, that could mean a maximum per employee of $21,000 of credit on there. So that would be for one employee alone if you happen to have employees that hit that $10,000 max. That 70% still applies if you're a recovery startup, but there is a limit. You can only, the amount of credit you can receive is capped at $50,000 per quarter. So let's just take a look here. I'm going to show you how to use a payroll report to, how do we go about calculating that credit? Well, it's going to be based on our payroll reports. So once we've determined when we're eligible, the first thing that we do is we run payroll reports that show by each employee their gross wages for each quarter that we are eligible, right? Now your payroll company can help you with that. So what you want to do is when you run those payroll reports, you want to make sure that those amounts match the amount that you reported on your original 941 form. So when you filed your 941 back in 2021 for each quarter, we want to make sure that the amount of payroll that we're working with this calculation, that it is the same amount there. Because how do we receive the credit? We file an amendment to our 941. We file the 941X form. So what we do is we run that payroll. Well, there are a couple things that we can't count. So we can't count, just like with FFCRA, we can't count any time period that was covered by PPP. We can't cover any time period that was covered by FFCRA credits. So I run my payroll and I pull out any payroll that was covered by PPP or FFCRA. Once I've done that, I then need to remove any ownership pay and any family members of ownership, right? We said we can't count wages for family members or ownership. So I pull that out, and then I keep in mind that I can only claim up to $10,000 in gross wages per employee per quarter. So we run the payroll reports, we pull for the time periods that we're eligible, we pull out the PPP, anything covered by PPP, anything covered by FFCRA, owner wages, family member wages. We pull all of that out. What does that look like in terms of the amount of credit? So you can see here by our example, again, you earn 70% of up to $10,000 in wages per quarter per employee. So in our example here, our employee had gross wages in quarters 1, 2, sorry, this, oh, excuse me, yes, they made this correct. I apologize. Quarters 1, 2, and 3, $5,000. They put in here quarter 4, but we know now there's no credit eligible for quarter 4. Everything ended September 30th. If we're talking about, if we're not talking about a recovery startup. All right, so my employee here, so Juan earns $5,000 per quarter. All right, I haven't hit that $10,000 cap, so that means that I can calculate a credit based on all $5,000 of Juan's gross payroll. Okay, that 70% credit is $3,500 per quarter just for Juan alone. So what that basically looks like is that if I was eligible quarter 1, quarter 2, and quarter 3, and I had already removed PPP, I made sure I didn't count anything that I received FFCRA credits for, I pulled owner wages, I pulled family member wages, this credit for this employee would end up being $10,500. All right, so again, a substantial credit, one employee, but I've made sure in every way possible that I was eligible for that credit. I have been very, very careful to make sure that I am not claiming any credit that I was not due. So how do we claim the credits? What do we do there? So you're going to keep all of the records for yourself. So you're going to run those revenue reports. You're going to show 2019 versus 2021. You're going to run all of your payroll reports. You're going to be keeping that because all you'll be sending in is that 941X form. All right. Now, basically, you file the form yourself if you'd like, but you also can use a tax preparer. You can often your accountants can do this. Payroll companies do it as well. Of course, there's a charge. It's not difficult to fill out the 941X form. And if you do an online search, I know there are videos on YouTube that show you how to fill out a 941X. So after you've done all the calculations, you can just search YouTube and look for a video that shows you how to fill out the 941X if you'd like to do it yourself. In New Mexico businesses end up mailing those forms into the IRS to an address that's in Ogden, Utah. And a simple little Google search will show you that address there. So keep in mind, just like with FFCRA, ERTC, there's a lot going on at the IRS right now with it. It will probably be over 6 months before you receive your checks. But once you receive your checks, you can spend that money however you wish. There is no limitation. So my takeaway with ERTC is that you're going to be very, very cautious in determining your eligibility. But once you've determined your eligibility, you should file for these credits. Don't let the fact that they are being audited very strictly now with the IRS, don't let that discourage you, because if you've proven that you're eligible, you should file for the credit. You're entitled to the credit. And remember, you have up until the middle of April next year to file. So it's not something that you have to do today. So that is our presentation on ERTC and FFCRA. I am just going to let everybody know that if you do need any more help, we have 2 options for you. One is that you can go to the CRSAIR website, CRSAIRNM.org. You'll find contact information for them, coaching information. You can sign up for coaching, provider resources, the ECECD recommended tools are there. So much there. So by all means, I really encourage you to visit that website. And we are going to go back over in a second to the main room and answer questions. But I would also like to let you know, and this address is going to be in the chat in the main room, is that if you have questions that weren't answered, that we don't get to today, something you think about after the fact, by all means, please go to tomcopelandblog.com. There are over 1,500 resources. We are the stewards of Tom's blog. Tom Copeland has retired. So we have 1,500 different resources are there for you. And one of the things that is there is a little link there that's called Ask the Experts. So if after you search all of the resources, if you don't find something, first you're going to go to the CRSAIR website. But if you don't find something there, you can go to the Tom Copeland blog website. And if you don't find something that you really were looking for, we do have a tab that says Ask the Experts, and you could go ahead and submit a question. So